our money mover of the hours, Aries Management Corporation President, co-founder, and CEO Mike Arougheti. Aries has $395 billion under management. Mike, welcome back. It's good to see you.
It's good to be here. Happy holidays.
Happy holidays. So is there an impact from this shifting dynamic of rate hikes to pricing and rate cuts?
You know, I think the market perceives that private credit is attractive because rates are higher, and I think that is part of it, right? Obviously, it's a floating rate instrument. We benefit when base rates go up, but if you talk to the institutional investors who largely buy private credit, what they're really buying is the premium to the liquid market. So even when rates start to move down, I don't think you're going to see any change in demand for private credit.
What if there's a downturn? How does your portfolio perform?
Well, the good news is now private credit's been around for 30 years, so we've been through Asian financial crisis, long-term capital, .com, COVID, GFC, so it's been tested. If you look at the positioning of private credit portfolios today, generally speaking, they're more conservatively positioned relative to any other time in the asset class's history. So anytime we have a downturn, obviously there's a risk of increased default or loss, but I actually think relative to historical performance, it should be better.
One argument from private markets lately, Apollo's a good example, is the idea that you can manage the illiquidity, and that because public markets have become so indexed, it's hard to generate alpha. Is that fair?
100%. There's two things to unpack there. One, if you look at liquid credit markets, any liquid investor is obviously going to be benchmarked or benchmark hugging, which means that by definition, you're going to be investing in industries that tend to be more cyclical. And people don't really like to unpack this, but if you go back in every historical crisis, there are 5 or 6 industries that make up the bulk of loss and default. So just through industry avoidance in the private markets, you could outperform. But two, which is important, if you think about liquid markets, it's actually adverse to value, right? So if you're an owner of a company and somebody can come in and buy a loan or a bond at a discount to par, that can be really disruptive. In the private markets, which I think is what you're referring to, it's a bilateral relationship. So everyone is aligned to seeing the company perform and do better, and I actually think that results in better credit performance.
So because of all this, it's gotten very competitive in your space.
Yes,
right?
Yes and no. I think more people are trying to come into the space because it's attractive and there's investor demand and there's client appetite, meaning there's demand for credit. But if you look at private credit, it's actually a fairly concentrated industry. So about half of the AUM that gets raised and deployed is with the top 10 managers. And I think what we've seen is with each cycle, that consolidation trend is actually increasing. So we're not really perceiving it as more competitive, even though there are a lot of people that are raising their hands.
Because I was going to say, if it is more competitive, does that make it harder to get better deals? Does that make it harder to hold the line on, offering incentives and deal structure?
Look, most markets are efficient. Even the private illiquid markets, there's going to be some level of efficiency. So over time, spreads come down, transaction structures get more, commoditized. But the way I would think about it is you drive value in the private markets through unique origination, through scale, size of your capital, flexibility. And so when you think about somebody like us who has $300 billion of private credit and $100 billion of uninvested, if there's a large deal for a high-quality company or a high-quality sponsor or a high-quality asset for that matter, there just aren't that many people that can participate in that market. So in some counterintuitive way, at least in the larger part of the market, it's less competitive.
What do we make of legacy bank CEOs who bemoan the bubble, they say, growing in private credit, and then start private credit desks of their own?
It's so funny. So I've been doing this for 30 years. I started my career in banks, and I still don't really understand this because private credit is just direct loans. And if you actually look at the structure of our markets, there are $3 trillion of C&I loans in the banking system. There are another $9 trillion of real estate loans and consumer loans. So when you take a loan to a good company or a good asset from a bank to a non-bank, still the same asset. So this idea that the banks aren't in private credit, I think, is a little bit of a misnomer.
So is it them just losing market share on loans?
I actually don't know. I mean, you're going to have to ask them because
they're
last
also
I checked,
upset that you don't get regulated in the same way.
We're very regulated. We're just not Fed regulated. And so one of the things that I think is, again, part of this headline, and it's been happening for the last 15 years, by the way, if you're 10 times levered or 15 times levered, and you have government guarantees, explicit or implicit, and you have an asset liability mismatch between your deposits and your liabilities, you should be heavily regulated, right? That's a financial structure that requires regulation. If you're unlevered or modestly levered, and you have a bilateral relationship between an institutional investor that's sophisticated and a manager, that probably has a different set of risks in it. So this idea of us not being regulated, again, is not true. We're heavily regulated by the SEC, by CFTC, by FINRA. It just we're not Fed regulated because we have a completely different financial structure. So it's an interesting thing.
Sounds like you're gearing up to make that argument. So.
I think everyone's doing okay. Obviously, at the end of the day, we just want to get capital into the economy to the companies that need it, and if it comes from us or the banks, so be it.
I want to ask about your stock price for a moment because it's up 60% this year. I think it's up a few 100% over the last few years. It's been a remarkable performer. What moves the stock on a given basis? Is it because private credit has boomed?
I think it's first, if you go top down, it's just a secular expression on the growth in alts, right? So if you just look at the alternative asset business, most of the alt managers have performed admirably. I think we've outperformed because we're over-indexed to the private credit markets globally. And obviously, given the growth in that market and the rate overlay, that's a good place to be. And so we've been very clear with our guidance in terms of the predictability and stability of our growth. And I think in the public markets, that matters. So a lot of the historical volatility that you saw in alts around the PE-centric or the balance sheet-heavy models, we've kind of pulled that out. So when you look at the income stream, it's just been very predictable in terms of its growth profile, and I think people are paying for that.
Finally, you mentioned the economy. We'd spent all morning talking about CPI, soft landing, hard landing, what have you. Are you looking for the economy to change in tone or direction next year?
Yeah, look, we have investments in probably 3,000 middle market companies. And despite the fact that people have been anxious and calling for a recession, we have not been saying that. So the last time that we were here together, we were pretty clear that what we're seeing in our portfolios is strong. And it's still the same. So now that we're at the end of the hiking cycle, we're seeing inflation moderate. I would expect that the economy will power through. Our pipelines are picking up. So as we've also talked about, now that rates have stabilized and people can actually get their arms around the forward earnings picture a little bit better, we're seeing transactions start to pick up. So I'm actually optimistic both for the economy and for the deal environment.
M&A, you're seeing M&A pick up?
For sure.
So firmly soft landing, it sounds like.
That's where I am.
Yeah,
that's right.
Well, Mike, thank you very much for coming on.
Always good to be here. Thank you so much.
Yeah, good to get an update on your thinking. Mike Arougheti, CEO of Aries.
Thank you. Appreciate it.